Welcome to StockTok's deep dive into Ross Stores Inc. Ross Stores is one of the largest off-price apparel and home fashion retailers in the United States, operating under the Ross Dress for Less and DD's Discounts banners. At the time of recording, shares are trading at 227.82, sitting just below the 52-week high of 228.71 and well above the 52-week low of 124.49. The RSI, or Relative Strength Index, a momentum indicator scaled from 0 to 100, reads 65.7, neutral territory, neither overbought nor oversold. The 50-day moving average sits at 209.13, and the 200-day moving average at 171.94. Price is comfortably above both, indicating a constructive longer-term trend structure. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Ross Stores operates a treasure hunt retail model, sourcing branded merchandise at deep discounts from manufacturer overruns, canceled orders, and department store liquidations, then passing those savings to value-conscious shoppers. The moat is built on scale, supplier relationships, and the operational discipline required to turn inventory quickly at thin prices. The StockTok score comes in at 43 out of 100, flagged as caution. Breaking that down, Valuation scores 3 out of 20, Health 14 out of 20, Profitability 13 out of 20, Growth 11 out of 20, and Smart Money a notably weak 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Ross Stores carries a trailing price-to-earnings ratio of 34.47 times, meaning investors are paying roughly $34 for every $1 of trailing earnings. That is a meaningful premium for a brick-and-mortar retailer. The PEG ratio, which adjusts the price-to-earnings multiple for the company's growth rate, and ideally sits near 1.0 for a fairly valued growth stock, reads 1.02. suggesting the market is pricing in growth almost precisely, with very little cushion. The EV to EBITDA multiple, a capital structure neutral valuation lens preferred by credit and M&A practitioners, stands at 22.11 times, elevated relative to where off-price retail has historically traded. The Guru Focus Value, an independent intrinsic value estimate, stands at 162.84 at the time of recording, implying a negative margin of safety of nearly 40%, meaning the stock is trading roughly 40% above that fair value estimate. In our view, the competitive moat here is real: cost advantage through the off-price procurement model, and scale advantages in buying and logistics create a durable edge. Wall Street analysts at the time of recording have a consensus mean target of 230, based on 16 analysts, with a high target of 250 and a low of 148. The next earnings report is due May 21st of 2026, with the street expecting earnings per share of approximately 1.67, a near-term catalyst worth monitoring. Market sentiment around Ross Stores, as of the creation of this video, leans neutral, with insufficient recent news flow to shift that reading in either direction. The price-to-sales ratio of 3.25 times and forward price-to-earnings of 30.93 times reinforce the picture. This is a high-quality business, but in our view the valuation leaves limited margin of safety at current levels. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist of profitability signals, leverage trends, and operating efficiency, comes in at 6 out of 9 for Ross Stores. Scores of 6 or above are generally considered healthy, indicating the business is improving across multiple financial dimensions simultaneously. The Altman Z-score, a multi-factor model designed to predict the probability of financial distress, reads 6.99, well above the threshold of 3 that separates safe companies from distressed ones. Put simply, balance sheet risk is not a concern here. On the debt side, the cash-to-debt ratio is 0.88, meaning the company holds roughly 88 cents in cash for every dollar of debt, not a net cash position, but not alarming either. What is particularly reassuring is the interest coverage ratio of 92.06 times. That figure means operating earnings cover interest expense roughly 92 times over, which is an exceptionally strong reading and signals that debt servicing poses virtually no risk. The current ratio, which measures short-term assets against short-term liabilities and should comfortably exceed 1.0 for operational confidence, stands at 1.58. Debt to equity of 0.84 is moderate and manageable for a retailer of this scale. Overall, the balance sheet reads as genuinely solid. Management has demonstrated disciplined capital stewardship. Next up, profitability. Is this business actually making money efficiently? The standout metric here is return on invested capital of 23.05%. Return on invested capital measures how effectively a company converts invested capital into profit, and any reading above 15% is generally considered a hallmark of a competitively advantaged business. 23% is an exceptional result for a physical retailer, and in our view, it is the single most important number in this profitability section. It tells you that the off-price model genuinely earns its cost of capital many times over. Working down the margin stack, gross margin, which is revenue minus the direct cost of merchandise, comes in at 27.71%. For context, off-price retail inherently operates at thinner gross margins than full-price peers, so this is broadly consistent with the model. Operating margin, which layers in store overhead and corporate costs, stands at 11.9%, a healthy figure that reflects the company's cost discipline. Net margin lands at 9.43%, and free cash flow margin, the percentage of revenue that converts to actual cash available to shareholders and reinvestment, is 9.7%. The near alignment of net margin and free cash flow margin suggests high earnings quality. The company is not papering over weak cash conversion with accounting adjustments. Return on equity of 37.13% and return on assets of 14.36% further confirm that this is a high return on capital business by any reasonable institutional standard. Onto growth. Is this business expanding? And at what rate? Over the trailing 3 years, ROST Stores has grown revenue at a compound annual rate of 6.8%. Extend the window to the trailing 5 years, and the compounded annual growth rate rises to 12.3%, a notably higher figure that reflects the strong rebound in consumer spending activity captured in the earlier part of that window. The deceleration from the 5-year to the 3-year rate is a signal worth watching. It suggests that more recent top-line growth has been more moderate than the longer-term average would imply. In the off-price retail sector, this kind of deceleration is not unusual as the post-pandemic normalization of shopping patterns runs its course. But investors underwriting a premium valuation, multiple need to be clear-eyed about whether they are paying for the historical growth rate or the more recent trajectory. Book value per share growth over the trailing 3 years has run at 15.3% annually, a strong result that indicates the company is compounding its intrinsic net worth at a healthy clip, supported by retained earnings and capital-efficient operations. The dividend yield, at 0.73% at the time of recording, is modest. This is not a name where the income component drives total return. The growth thesis for ROST Stores rests primarily on continued store expansion into underpenetrated markets and the structural tailwind of consumers trading down toward value-oriented retail in uncertain economic environments. We would want to see revenue acceleration before ascribing significant growth premium to the valuation. Now let's talk smart money. What institutional capital is actually doing with this name? 10 top-tier guru investors currently hold positions in ROST Stores, according to the data at the time of recording. Among the most notable, Viking Global Investors, the multi-billion-dollar long-short equity fund, holds the name at 1.52% of their portfolio and has added to the position by 56.51%. A meaningful conviction increase. First Eagle Investment Management, known for its value-oriented margin of safety discipline, holds the stock at 0.47% of portfolio and has added 2.39% to the position. On the other side of the ledger, Jensen Investment Management has reduced its position by 29.92%, and Maverick Capital, managed by Lee Ainsley, has reduced its position by a substantial 82.32%, nearly a full exit. That divergence in behavior among high-quality institutional managers is a data point that warrants careful interpretation. Turning to the broader institutional picture, only 8% of 13F institutional filers, the quarterly disclosures required of large money managers, are classified as net buyers, compared to a threshold of 50% or above that would constitute broadly bullish institutional sentiment. That is a decidedly weak reading. Insider ownership stands at 1.15%. Management owns a very small slice of the company they operate. More pointedly, over the most recent 3-month window, insiders have filed 0 purchases and 7 sales. Insider selling alone is not always bearish. Executives sell for many reasons, but the combination of low ownership and no buying activity gives us pause. Overall, the smart money signal for ROST stores is mixed at best, and in our view this dimension deserves weight in any position sizing decision. And finally, the verdict. Let's bring it all together. On valuation, the data suggests ROST stores is trading at a meaningful premium to its intrinsic value estimate, with a trailing earnings multiple and EV to EBITDA that appear stretched relative to peers. In our view, the margin of safety is thin at current levels. On financial strength, the balance sheet is genuinely solid, exceptional interest coverage, a healthy current ratio, and an Altman Z-score well into safe territory represent a real asset for long-term holders. On profitability, this is where ROST stores earns its reputation. Return on invested capital of 23% and near-perfect alignment between net margin and free cash flow margin confirm a high-quality, capital-efficient operation. On growth, revenue deceleration from the 5-year to the 3-year window is a trend we would want to see stabilize or reverse before the market's premium multiple feels fully justified. On smart money, the combination of weak net institutional buying, near 0 insider ownership, 7 insider sales, and no insider buys in the recent window is a cautionary signal that we believe warrants respect. The overall setup, in our view, is one of a fundamentally strong business that the market currently appears to be pricing for perfection, leaving limited room for error on growth or macro. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on ROST Stores Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.